Hi traders, welcome to Market Outlook, trends, risk events and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so for this week. Follow pretty much the standard format. Hopefully you guys enjoy that format. Yeah, we'll just go through where markets are currently. We'll look at equities actually and look at Nvidia's results, which are upcoming after the US close on Wednesday. So we'll just briefly look at that and a chart around those Nvidia earnings actually, and also then the stock indices as well. Just looking at those charts of the major US indices, that is. We'll briefly touch upon gold and also Bitcoin, which we can't avoid for sure, as really we're seeing a stampede of crypto bulls post-election for sure, US election that is. After that, we'll just get into last week's main event, mainly US CPI data. We'll touch upon that, and also some positioning actually in the dollar, which is of interest. We'll touch upon the UK data from last week before. Not too much data this week really, and events happening. US CPI we do have, and then the PMI data, European and UK always in focus really, and especially with the Eurozone struggling, of course, the Euro struggling with potential tariffs, and also, of course, the ongoing stagnation of the economy. Okay, yeah, this is really a summary of what we hope to get through. So, yeah, well, just check out how markets are shaping up currently, really. I mean, really interesting post-election, really. The moves in some assets have sort of continued their momentum following Trump's victory, of course, that clear-cut victory, really, being very bullish for some assets, and really sort of dropping in the uncertainty, really, that we all thought would probably happen with a sort of elongated and prolonged sort of count session, really. The clear-cut victory has at least sort of reined in that uncertainty you would like. The greenback, really, that's remained resilient. Gold, interestingly, that continues to pull back. And then the sort of bump in equities that we have seen, well, we saw on the week of the election, that's sort of failed to keep up really as the benchmarks take a breather, really. As I mentioned, crypto, of course, anything crypto related, really a huge area of market interest, with various coins really making quite astounding gains, and Tesla, of course, grabbing the headlines, which still continues higher. China had a disappointing week actually, as stimulus failed to provide really an optimistic boost, and earnings continue to drip in. We had Disney last week up over 12%, I think, streaming positive, but we do have a big release, obviously, as the earnings season comes to a close, with Nvidia, as I say, on Wednesday evening UK time. Global equities, just pull up a couple of charts first of all. I was going to look at gold first, but we'll just talk about global equities first, which you can see. This is a gold chart, but let's just pull up equities first of all. Just that sell-off after making those highs just above 6,000 on the S&P 500. All lower on Friday, and actually for the week overall, global equities, US led the decline, really should be viewed kind of in the context probably of its significant outperformance in the days following the US election results. You can see the big bump here, big close upon close, record highs, but then we just pulled back, really. Probably hard to attribute it to macro data, of course. We've seen pretty decent data continue, really, and the economic surprises indices that actually touched new highs after the summer's decline. And there was, yes, this notable decline, I guess, on Friday and throughout the week, really. Financials, energy, utilities all registered gains, actually, but tech really led the downturn. And also we had a downturn in healthcare as well, pretty sharp decline, leading to really defensive stocks underperforming cyclicals. Quite interesting that. Friday then, just the close on Friday, that sort of added a bit more uncertainty as well into markets. The VIX ticked a little bit higher, and it was actually the worst session since the election for those US indices. The S&P down 1.3%, Nasdaq down 2.2, Dow down 0.7. As I said, mega cap tech, really Magnificent Seven. They led the declines on Friday actually as well. And expected moves for this week in options markets actually have widened quite a lot recently. I think the Nasdaq's now predicted to move by over 2.2% or so on the week. And certainly some of the big tech names or other tech names as well, Supermicro Computer, Palantir, expected to see big volume volatility. Sorry, just on the sort of downturn then in stocks as opposed to sort of other assets. Um, uh, you kind of think the market is slightly reassessing tariffs, really, and tax cuts. Those are key policies of Trump 2.0, really, and really his recent cabinet appointments, including really quite big China hawks. Really, that sends a message that potentially the immediate focus might be on trade and tariffs, really over tax reforms, which are domestic. Um, he's obviously attained a clean sweep, really. So House, Senate, and obviously the presidency. So yeah, that's one view. Other views are that trade and tariff policies will take longer to process. It just depends, yeah, how quickly they get those through the houses, and then obviously hit Europe, hit China with those tariffs, especially. As I say, yeah, they all require congressional approval and come with probably fiscal constraints. Um, that is tax cuts actually, and possibly then that argument is that they are sort of a secondary priority for now. Emphasis on tariffs, though, that would increase uncertainty, market volatility, particularly in those sectors heavily related to global supply chains. That kind of means then high beta stocks, including small caps, cyclicals, um, especially vulnerable to trade disruptions. Global markets then, they would probably feel outside impacts as trade tensions escalate. If you think about the first Trump 1.0, China, Hong Kong got hit really, and that then poses downside risks for equities in general. And as I say, particularly those exposed to international trade. So that's the thinking just around this downturn in stock markets, really. Um, and we're just sort of fairly quiet actually at the moment. Mixed performance in Asia, to checking that out. South Korea was up quite handsomely, over 1%, nearly 2%. European markets, yeah, slightly in the red. US futures mixed. So yeah, stock wise, just technically, you can see, well, the previous highs around 58.78 in the S&P, just through that now. So then you've got the first fib level at 58.05. And then this is the 50-day moving average. It is at 57.72 there. That's the S&P 500. Nasdaq similarly, yeah, just down through those previous highs from July, and then obviously just before the election, end of October. So you've got that 50-day just below now at 20,102. The first fib level we're just on actually at the moment with tallies with some of those recent highs. That's at 20,381. Dow again turned lower. We haven't actually bumped up. Look, you can see the fib level just around there. So you've got those previous highs around 43,289. We're not there yet. And then the first level just above 43,000. I just wanted to touch upon gold and Bitcoin actually as well. Here's the gold chart. Worst weekly decline in more than 3 years actually. And if we just show you that decline here, you can see big tumble, 3 weeks now of consecutive losses. And we've just got towards the 100-day moving average, just checking that is 25.47. And then you've got the halfway point of this sort of these lows from sort of June up to the high, recent record high, of course, in October. That halfway point is at 2,533, and we just sort of bounced off that around that level. So that's decent support. So next level, 25 94, and then above that 26.53. Really, that's gold. Interesting, really. Obviously, Trump's policies being inflationary. Causing the dollar to rise substantially. So that's a hindrance to gold, of course. And then it's also rising dollar would be really sort of dampening demand from central bank buying, especially sort of emerging markets central bank buying, which we have seen this year be pretty strong. As I mentioned, the clear-cut sort of election victory as well, that's reduced uncertainty. So the sort of safe haven bid probably has come out of gold as well. And then mentioning those sort of weaker EM currencies, potentially that will happen on the tariff policy, especially, and that makes then gold less attractive. Those are sort of some of the reasons for this downturn, but certainly other people believe there's an underlying safe haven bid, underlying central bank bid, and ETFs as well have been buying, I think, recently as opposed to the start of the year. So yes, should be some underlying support for gold going forward. For Bitcoin, really interesting. And again, Trump's win kind of unleashed, as I mentioned, that sort of stampede of crypto bulls really intent on driving Bitcoin. Certainly to, you would think, to 100,000, right, is the big number. No doubt about it. Price has risen, I think, around 30% since November 5th, election day. Obviously, we topped, well, where did we go? 93,495 was the record high then. Interesting, the entire crypto market that has surpassed $3 trillion now for the first time on record. And Bitcoin worth about as much as Elon Musk's Tesla, actually. Interesting. Well, no, Bitcoin now worth as much as Tesla, Meta, and Berkshire Hathaway put together. Really, it's the promise then of sort of lighter touch US regulation, if you like. That means investors really scrabbling to buy Bitcoin. Obviously, we've had this exchange traded funds, Bitcoin exchange traded funds, that is. So we've seen flows into those ETFs rocket really in recent days. In fact, I think I'm just checking some data here. The LSEG data shows the largest ETF tracked by Reuters took in a net 3.5 billion in the week to November 14. So that's the most since March 15. Really, then, yeah, it just seems like it's a question of time, really, doesn't it? We're easing these overbought positions, which is healthy. Maybe need to ease back a touch more down to possibly 84 would be decent support. But then 93,495, the key number before, possibly this is just bullish consolidation towards a push blowout top, really, towards 100,000. And then I guess the proof's in the pudding, potentially with obviously Trump, sorry, and how bullish he will be for crypto. Okay, we will go to last week's main events now. I should say, if you do have any questions, please do ask them along the way. So I didn't get into NVIDIA, did I? Just before we get into last week's main events, just got a chart with NVIDIA's revenues. As earnings season, as I said, coming to a close. NVIDIA bringing that to a close, really. Kind of the bellwether, isn't it, for AI mania, and really has boosted stocks, boosted the broader indices as well because of its hefty weighting, no doubt about it. Shares are up nearly 200% this year, incredible, and that gain has actually seen it dethrone Apple actually as the world's most valuable company in October. That was record highs then for the S&P, driven in large part by obviously NVIDIA. But we should say their blistering, really multi-year run has also raised the bar for earnings outperformance, of course. And that does mean a slip up could fuel worries that kind of the market's AI hopes have outstripped reality. Analysts see third quarter revenue, you can see here, increasing by over 80% to 32.9 billion. And interestingly, the options markets, they price around a plus or minus 8.8% move in the stock on the day after earnings, essentially. So Thursday, that's in line actually with the average, the absolute move seen in earnings over the past 8 quarters. So 8.8% plus or minus is what options markets are seeing for NVIDIA after their release. Okay, let's get on to now US CPI data just from last week, and we touch upon some other bits of data. Here's a review really of just those key numbers. CPI core, that's the number that the Fed focuses on for sure, so we've put it in the big box here. Core month on month rose actually 0.28%, so rounded up to 0.3%. And the prior which was expected, as I say, slightly down from an unrounded 0.31% previously, that prior number, as I say here. The annual number, that came in line at 3.3%, matching the prior month's pace as well. Around, I think, 60% of the increase in core prices attributed to shelter, which ticked higher in October, but does actually remain on a cooling trend further out on the medium term. All other major components in the core inflation basket, they did show easing price pressures. So pretty important that, even though it was obviously a tick up to 0.3% really, touch up anyway. The headline figure, that also rose in line with expectations. 0.24% month on month, in line then with the 0.2 forecast and the prior, but slightly up on an unrounded basis from 0.18. And then the year on year number, that rose by 2.6%. I've put 2.7 in here. Should be 2.6, I believe, in line with analyst estimates, and up from the 2.4%. Sorry, so that should be 2.6, which is up from the 2.4. Yeah, the uptick then on that was purely related to a weaker print a year ago, so year on year comparison. Just for your guide, there is still another CPI report before the December 18 Fed meeting, and then both reports, of course, will be accounted for when the Fed makes their decision. Just got a chart as well, just with those numbers, and also the PCE numbers. We get those at the end of the month. So next Friday, I believe. So just watch out for those as well. The Fed's favored inflation gauge, really just a broader index of broader measure of prices really in the economy and for businesses as well. We did have a series of Fed speakers last week, all really expressing uncertainty over where rates will ultimately settle. We had Kashkari, actually, he's a Fed member before the data, said that if inflation between now and the meeting comes in hot, then the Fed can pause. However, this is kind of inline data really, and it sort of favors probably another 25 basis point rate cut in December. Of course, there is one eye on Trump's policies, tax cuts, tariffs, increased spending, all seen as inflationary. We will get probably the nominee for the Treasury Secretary this week. And we did see actually an interview with Scott Bessent, who is the favorite, I think, who was really quite insistent that any new measures would be phased in slowly, and they were very cognizant, if you like, of the inflationary worries and concerns of people in the market. But we shall see what happens there and whether he is nominated, of course, as well. For the Fed, then, they've said they will not front run fiscal policy, but then Powell did suggest last week, actually, at the press conference, that they would implement policy into economic forecast models and the results would be taken into account. Yes, so interesting, really, what happens, of course, with those tariffs and inflation, of course, going forward. We also had remarks from Powell last week, really interesting, pre-CPI actually, where he seemed to endorse actually markets more cautious pricing on Fed easing. He put greater emphasis on the strength of the economy, actually, and how that allows the central bank to approach the upcoming policy decisions. I think he used the word carefully. And market expectations actually after that speech for a cut in December, they declined by around 5 basis points, actually, from 20 basis points or so priced in to around 15, which is what I have here. So if you think that's a 60% chance as opposed to an 80% chance before. So yeah, just interesting with Powell's comments for sure. And then we also had retail sales on Friday, somewhat stronger than expected. Slight disappointment in the core and the retail control group, but that was really completely erased by a huge upward revision to already good September data. So yes, just a slight reining in of that those chances of a Fed rate cut in December. I said I'd mention the dollar. Just pull up a chart of the DXY, which is here, and you can see the cracking run really. And we're up to obviously previous highs of the year. Before then, we get up to the high from October at 107.34. This is the dollar index, of course, so we're just around that level now. You can see the big push since the election, that massive big day on the Wednesday, and then further real strength in the dollar. I said we mentioned positioning, actually. Interesting speculative futures positioning, really. That's what I'm talking about. That shows that actually net dollar longs versus the rest of the G10 rose to the highest actually since July, and that's data until last Tuesday. Open interest terms, if you look at that, then that's still well below April's peak, but is high. And you would suspect probably long dollar positions probably grew further throughout last week. As I say, those figures only up to last Tuesday, so they probably grew further last week, and probably failed to capture really the depth of this shift to really a structural bullish stance on the dollar after the election. Now we kind of think potentially positioning slightly stretched on dollar longs, and the greenback possibly remains at risk of some technical correction in the near term, but obviously medium term and further out, Trump policies seen to be bullish for the dollar. You can just see technically on the chart we're slightly overbought, just easing that with that down day on Friday. But certainly last week's high 107.06, and then that previous long-term high at 107.34. Okay. UK data then last week. Just bear with me 1 second. Yeah, we'll move on to this week's, UK data. Actually, last week we had GDP. That was slightly disappointing, actually, owing to a surprise fall in activity during September. 0.1%, I think it was. So far cry from the sort of 0.7, 0.5 we had in the first and second quarters. Does that mean the economy is slowing? Of course it does, but probably not as much as the figures suggest. A lot of that strength seen in the first half of the year was down to sort of non-consumer sectors that have less to do with underlying economic fundamentals. So just bear that in mind for the UK. We also had wage data out last Tuesday. Unemployment, that ticked up above consensus forecasts. But we do take that data with a pinch of salt, really, because of the statistical issues that they have collecting that data. But wage growth numbers were still relatively sticky. Moving on to this week's data, UK CPI, here's a preview of those main numbers. Expectations for the headline to tick up to 2.2% now, actually. And that would be 40 basis points below actually the last MPC forecast, but it is up from the prior 1.7% reading, which was actually then the below target for the first time since April. All of that really due to a 9.5% rise, actually hike in the energy utility price cap, and that combined with last October's utility price cut dropping out of the inflation calculation, then that means prices go higher on a relative basis year on year. So yeah, expectations 2.2 in the headline. The core, that's seen moderating slightly because you strip out, of course, volatile food and energy costs. So yeah, that's seen moderating a tenth to 3.1 from 3.2. And then the all important services number, which is certainly what the MPC and the Bank of England watch. So just check that number out as well. That's seen around 5%. So it slowed from actually from previously 5.6 to 4.9 in the previous report, but now seen around probably 5% print, which would actually match the MPC's November NPR forecast. For policy then, of course, the release will be sort of checked out to see if there are any elements which bring a December cut back into contention. Expectations of that now around 20%. They've certainly been pared back since the US election and also since the UK budget, which is seen as inflationary and hopefully providing some growth as well. So just less than a 20% chance now of a 25 basis point December Bank of England cut. And we do get the CPI published the session before the November CPI. That date is published in the session before the Bank of England rate announcement. If I just pull up cable, so this is obviously sterling against the dollar, big turn last week. You can see that big red candle there. And we had sort of been oscillating around 129, thinking that may be support. You can see the halfway point of this move from the April low up to the October, late September highs. Halfway points at 128.62, but we lost that. Yeah, went through 127 as well. So we've got another fib level here. 125.40 or so, and then 61.8 of this move is at 127.29. That is cable. We also get as well PMI data, as I mentioned. Always use a really good matrix that Reuters produce actually. So PMI data always important, especially for the Eurozone. Flash PMIs will also, of course, be one of the first reads into the Eurozone post Trump's victory, of course. Yeah, since then we've seen, well, German ZEW business sentiment for the bloc and Germany coming in short of expectations, actually. The collapse of the German coalition, of course, plus clarity really on the US political developments, probably a big cause of pressure in sentiment indicators, with obviously tariffs being a high priority potentially for Trump. Market consensus for these numbers then for the PMI manufacturing probably remain around 46.0, while services is slipping a touch, but still above 50. But all in, that potentially pushes the Eurozone composite back into contractionary territory at 49.9. It's neck and neck, really. It was 50.0, possibly dipping into the red. Just on this matrix, I should explain, blue squares are sub 50, so contractionary, and then the red ones, orange ones, are above 50, so expansionary. And you can just see the changes in the global economy in the different areas. Regions, sorry, and then Eurozone still lagging, sort of UK, US. Interesting as well, I think some of the pressure could in the Eurozone be offset by actually a boost in orders, which is basically stockpiling ahead of potential tariffs. And if you remember, that sort of tightening supply side developments actually can bolster the PMI, which is what we saw during COVID. So yeah, just an interesting point on that with potential stockpiling ahead of tariffs. UK PMI, where is that? That's seen at well, printing in line really with October's figures after several months of pressure. Numerous factors at play, of course, with the UK budget being a huge one. If you're in the UK, you'll know any businesses have been holding off on lots of decisions until they saw the budget. Obviously, then we've had expectations of and then the confirmed victory of Trump as well. So possibly then the UK narrative slightly different from the Eurozone because of that budget as much as anything else. Overall, I think PMIs are meant to stabilize close to October's figures now after, as I said, declining in the last few periods. The composite, though, will be above 50. I think is expected around 51.7 versus 52.6 previously. Okay, I've rattled through there in 30 minutes pretty much. Don't see any questions. I should have mentioned if you always have questions, have any questions, please do ask them. However big, however small, whatever we've looked at, any trade setups you want to look at, we can always have a look at those as well. But I don't see any questions at the moment. I've covered gold, which I know a lot of you sometimes have questions about. But yeah, a few things to look out for this week, and especially Nvidia, UK CPI data on the Wednesday. Before then, we get into, well, the last week of the November, then, which, as I said, we have US PCE data on that last Friday, I believe. Before then, the following Friday, we do get US non-farm payrolls, which will be, yeah, very, very interesting and potentially volatile. Okay, I'll wrap it up there. Great to have you all on the call and stay all this time as well. Really do appreciate it. Please do follow us on social media, and we do write, as I say, a daily commentary published on the website, has a chart of the week, and it's published after the US close. So it looks at all the closes and also the day ahead. Okay, take care out there, and we will speak to you same time next week. All the best.